Today's masterclass is something that I want to combine basically psychology with a bit of technical. We're going to go over a couple of different things and we're going to discuss what some of you may not be aware of, which is, the fact that dopamine itself isn't the molecule of pleasure. And a lot of people think it is. Does anyone know what it's the molecule of? Does anyone actually know where that dopamine comes from? Dopamine is actually the molecule of anticipation. Okay, so it spikes when you imagine what could happen, not when it actually does. Meaning, you're on the markets, you're looking at the trades, like you're looking for a trade, you've got the S&P 500 up, whatever it is that you trade. Now, you see the setup forming, you picture the breakout happening, you calculate the upside, and what feels like confidence, a lot of the time it's just anticipation. And the thing is that anticipation, which is often misguided as confidence, is the dopamine. And whether you win the trade or you lose the trade, and this example I'm going to give you all a bit like sex, is the win, right? Because even if you win, dopamine fades fast, right?
And it's gone.
Even if you win. So what happens when you close a beautiful winning trade? You feel great. Now, be honest, chat. What do you do 10 minutes later? You take a win. You've made $1,500. You could close your laptop, go to bed, and make more than your week's wage in an hour or so. But what do you fucking do? Yeah, that's right. You go again. You're already looking for the next trade, and absolutely nothing has changed in the market, but something changed in your brain. Why? Because the dopamine fades quicker and your brain wants another spike. Right? So what happens to a lot of us, and it's almost like you can't control it sometimes, your emotions and that dopamine and that chemical that's induced into your brain takes over, but we get into this loop of overtrading. Why? Because we have the dopamine spike, we enter the position, win or lose, the dopamine fades, and then our brain starts chasing. We want that dopamine spike again, just like a drug addict. And so you're no longer reacting to price action. How are you so far away? And the way that you stop this loop, it's actually not by willpower, but by making your dopamine trigger by the process and following the process, not the profit. Okay, so how do we do that? All right, how do we actually move from stimulation to structure? From chasing the feeling and reacting to that dopamine to actually following the process and executing the plan. Because when you do that, that's when consistency begins. That's when you start to find, your win rate increase, your confidence is increasing, you're sitting out of trades because you know that setup's not there. And in the heat of the moment, what you want to do is just try to neutralize the dopamine, right? You guys see me, I'm very neutral a lot of the time, and that comes from experience. But when you're in the heat of the moment, if you realize that your dopamine is spiking, you feel urgency, you need to pause. If you feel overconfident, let's say you're fucking super bullish that you could put the house on it that the S&P 500 is about to break out. What I want you to do is stop for a second and actually look at everything you don't want to happen. Right, it's something that I do. If I'm about to put on a multi-million-dollar position, I'm looking at everything that's going to tell me the opposite. If I'm thinking that this is going to break out, or it has broken out, I'm looking at everything that's going to tell me the opposite. Where's the resistance? Where's the selling pressure? Are the bears about to come in? Is this worth the risk? Don't just get overconfident. Look at the opposite of what you actually want to happen. All right, take some time to breathe and then execute a position based on process, not profit. Because what happens is you think that you're seeing all these things happen on the chart. Your brain's only looking at the information you want to see, and then you think you're going to miss it, don't you? You get that FOMO. Well, I'm here to tell you, you won't fucking miss it. There's always going to be another trade. And because when you feel this, you're not actually reacting to price action. You're not following your process. You're reacting to the dopamine and the chemicals that have flooded your brain. And there's always going to be another trade. You just need to live to see another day. Right? Is this true or not? And if this is true for you, I want you to remember you can't fail if you don't quit. Because eventually what's going to happen, your brain learns to follow your process, not the profit, because it's like, how many times are you going to put your hand on that stove and keep getting burnt, right? Sometimes some people need to put their hand on the stove for a long period of time, others very short period of time. Everyone's different. But you can't fail if you don't quit. So what I want you to do if you are struggling is simplify everything until you have clarity. Why? Because until you know exactly what you're fucking doing, your results are just luck, even if you're profitable. Until you have the pattern recognition to know exactly what you're looking for, at exactly what asset, on exactly what time frame, in exactly what session, you're guessing and your wins are luck. And guess what? Luck is not an edge in the market. So I want you to remember, if you're struggling to find consistency, if you're struggling to find profitability, focus on one asset, focus on one time frame, focus on trading one session, and focus on one setup. This way you can master one market before you even think about touching anything else. Remember, you want to have a long-term relationship, not a one-night stand. Clarity is king, so you can focus on trading one time frame. For me, I'm focused on the 2 and the 5 minute. Yes, I look at the 15 minute, but I'm focused on my entries on the 2 and the 5 minute. I don't deviate from that. Okay, I'm focused typically, well, not me, but if you're a beginner, just be focused on one session. Maybe that's the London session. Show up to the London session every day, because that familiarity with the session that you're trading is what actually builds the edge. You understand how the market moves, you understand the average move that you get in that session, you understand the volatility, when it's too volatile and you should stay out, or when it's perfect market conditions and you should take a trade. Focus on one setup so you can execute the same setup every single time until you find none. Okay? If you can do that, you'll find consistency. And to be honest, consistent trade is like, it's boring to be consistent. I get it. But it has nothing to do with strategy, and it has everything to do with your behavior. You have to show up to the market no matter what, because, you know, the market doesn't care what your mood is. You have to refuse to quit, because every mistake is a lesson with a price tag. Start small, accept losses as lessons, follow your process, not your profit. All right, because at the end of the day, you know, if you're going to increase your size without earning it, you're going to lose it. The market will humble you, and I guarantee it. Size is actually earned in the market. You don't just get to place 20 lot sizes and 40 lot sizes. Okay, it's earned. It takes time. And your losses should be small, but you should accept those losses as lessons, because at the end of the day, it's tuition, not failure. Right? You need to follow your process, not your profit, and that maturity is built, not given. That's what consistent trading looks like. All right? Now, I want to talk about what we all classify as an A+ setup. All right, because most beginners, they tie their A+ setup to a specific market structure, and that is a mistake. Number 1 in the chat if you think this is true. Number 2 in the chat if you disagree or you don't do this. All right. Okay, so a lot of you do this. A lot of you agree that you tie your A+ setup to a specific type of market structure, and if you're a beginner, you should. But if you've been trading for 3 or 6 months, then that's a different conversation. So I want you to forget the old definition, because it's not tied to a specific market structure, right? When that market structure isn't visible, like for example, let's say you only trade weak pullbacks with divergence from a key level when you have premium fuel in the tank. What that means is that you're only going to take that trade, and when that structure is not visible, when that's not right in front of you, you tell yourself that there's no opportunities, there's no trades to be taken, and there's no A+ setup, which means you sit out of trades. You don't take trades because you don't see that A+ setup, and then because you're not taking any trades, you force something which is a fucking shit setup, just because you want to take a trade for the sake of it. Your discipline battery's being used up and your patience has been used up, that you just take a trade for the sake of it because you don't have that A+ setup, right? What I want you to do is change your perspective from the old definition to the new definition, and I want you to basically tie it to your probability bucket, right? The number of probabilities that you have stacked in your bucket and the strength that each of those probabilities hold. When enough of those probabilities are there, that's what your A+ setup is. It doesn't have to be a specific type of market structure unless you're a very, very green beginner, okay? So for me personally, and I've been trading, I mean, you guys see my stories and my Instagram, I've been trading 40 lot position size. This is a notional value of 13 million US dollars. So we're talking about 20 million Australian dollars, right? And my A+ setups recently have been stacking my probability bucket with a key level, using candle psychology, a simple moving average, MMT algo, and taking profit towards the VWAP, or the closest resistance. So I'm taking $20 million positions for my fund using these probabilities that are stacked on the screen. And yes, the market structure or the fuel or the type of, actual, whether you say it's 98 or 91, of course, it's volatile as fuck. Trump's tweeting one day something positive, one day something negative, the market's up, the market's down, I can't control it, I don't know what he's gonna say, right? But we gotta trade the market that we have, not the market that we want. So your A+ setup, when you stack multiple probabilities and you have a high conviction in each one of them, you can take a trade because you've got multiple things aligned that have a significant amount of weight in the market, right? That's what tips the odds in your favor. I don't want you just to tie it to market structure. Is this making sense? We're gonna talk about VWAP when we get on the charts, Tommy. The other thing I want to talk about is one-to-one risk to reward. I think it's just super underrated. I want you to lock in the 90%, you know that. What a lot of beginners do is they chase, 1 to 3 or 3 to 1, whatever you want, way you want to frame it. But they're chasing really big trades and really big risk to rewards instead of locking in the 90% consistency. So if you're chasing 3 to 1, you're basically hoping that the market moves in a straight line. You're watching a winner reverse and become a loser. And then you have emotional damage from giving back profit to the market when you saw your position in $2,000 profit and then it went back to break even. Right? And the reason that you're doing this, if I draw it out for you, let me get my drawing tool open. But draw this out for you. Let's say, for example, we'll draw out 2 scenarios. Right? Let's say that this is our risk. This is our reward. That's a 1 to 1. And this, we're aiming for, a 1 to 3. Well, we know the market doesn't typically move in a straight line. So if you're chasing a 1 to 1, it might go like this, you take profit and go back up. Now you carry that concept straight across into that 1 to 3 trade that you're hoping for, and you have the same start, right? But then what happens? It comes back to break even, and then it goes down here, and then it comes back here, and then you get stopped out. So you saw your position go from plus, $1,000 profit to now negative $1,000 profit. And often this is tied to the ego of beginners because you're looking for that 1 to 5 risk to reward. You're trying to take that monster move instead of just focusing on locking in the 90%. And that 90% is the 1 to 1. So if you can focus on the 1 to 1, you can then build the consistency, you can build the buffers in your portfolios or your funded accounts, and then you can look for 1 to 2s. You can hold those trades for a little bit longer. You can develop the emotional skill set you need to succeed to hold on to trade longer and be able to handle that drawdown. But that's what a lot of people, especially beginners, do. They're chasing the big trades and they get emotional damage from giving back profit when you could have taken the smarter option and locked in that 90%. Maybe it's at the resistance or the VWAP. Build consistency and confidence with the small wins because the market doesn't move in a straight line, so you shouldn't expect it to. And for most of you in here, those small consistent wins are going to beat the big ones every single day of the week. Like there's just no contemplating it in any way, shape or form. All right. So key takeaway, simplicity, clarity, 1 asset, 1 time frame, 1 session, show up every day, find your probabilities, stack them in your favor, get the pattern recognition by trading 1 asset on 1 session, and just look for the 1 to 1s, take profits at the VWAP, whatever, maybe there's a resistance before the VWAP, whatever it is. Don't look for those 1 to 3s or those 1 to 4 trades. Right? All in all, follow your process, not the profit, and consistency is not the result of winning every trade, it's the result of executing the same process every time. So for me, that's been key level, candle psychology, MMT algo, and multiple time frames aligning, right? Then I take profit at the VWAP or at the closest resistance, looking for a 1 to 1, 1 to 2 at most.